In today's rapidly changing world, the idea of retirement is no longer synonymous with slowing down or stepping away from the workforce entirely. Increasingly, people are choosing to pursue second careers or start their own businesses later in life. And this shift in mindset is transforming the way we think about financial planning. The traditional approach of saving for retirement and then living off that savings may not be enough for everyone. Instead, many are opting to redefine their futures by venturing into entrepreneurial endeavors or taking on new careers in their later years. However, starting a second career or launching a business after years of established work brings a unique set of challenges, financial challenges. In particular, when you're closer to retirement age, time becomes an even more critical factor. Your financial decisions need to be strategic, ensuring that your new career or business venture doesn't just fill a gap in your income, but also supports your long-term financial goals. Whether you're launching a consulting business, pursuing a passion project, or turning a hobby into a full-time endeavor, understanding the financial intricacies is key to your success. The good news is that second careers and late-life entrepreneurship can be incredibly rewarding, both financially and personally. But without the right financial planning, these ventures can pose risks, especially if you're relying on them for retirement income or wealth building. You may have fewer years to grow your wealth compared to someone starting a career earlier in life, and it's crucial to be mindful of both immediate and long-term financial implications. In this audiobook, we'll explore how to navigate the financial landscape as a late-life entrepreneur or someone pursuing a second career. You'll learn how to set realistic financial goals, manage cash flow, minimize tax liabilities, and ensure that your new venture fits within your broader financial strategy. More importantly, we'll provide you with the tools and insights needed to balance short-term financial needs with your long-term aspirations. Whether you're already in the process of transitioning into a new career, contemplating a business idea, or simply looking to understand the financial planning aspects of this shift, this audiobook will give you practical advice on how to secure your financial future while making the most of your second act. Now is the time to take charge of your financial future and embrace the opportunity to build something meaningful. Let's dive into how you can effectively plan for your second career or entrepreneurial journey and ensure it supports not just your goals today, but your wealth and well-being in the years to come. Chapter 1. Understanding the financial landscape of a second career. Starting a second career later in life or becoming a late-life entrepreneur is an exciting and often empowering step. However, with this exciting opportunity comes a need to reevaluate your financial landscape. Transitioning to a second career or launching a business requires careful consideration of your financial situation, both now and in the future. Without a strong financial plan, the new venture could become a source of stress rather than opportunity. In this chapter, we'll explore the financial realities of pursuing a second career and starting a business later in life. By understanding these challenges and opportunities, you can better navigate the financial decisions that will help secure your future. This chapter will also cover the importance of aligning your new career or entrepreneurial goals with your existing financial situation, and why it's crucial to plan strategically to avoid common pitfalls. Shifting financial priorities in later life. As you transition into a second career, your financial priorities may differ significantly from what they were in your earlier working years. In your initial career, you may have focused heavily on accumulating wealth for retirement, paying off a mortgage, or saving for your children's education. Now that you are in a new phase of life, your focus may shift towards generating income in a new capacity, while also ensuring that your retirement plans remain on track. However, the biggest difference is that you likely have fewer years to work and save, which makes time an even more precious resource. This shorter time horizon requires a more calculated approach to finances. Every financial decision you make today, whether it's taking on debt to fund your new business or adjusting your retirement savings strategy, has the potential to impact your long-term financial security. In your second career, you may not be able to rely on the same salary you had in your previous job, especially if you're transitioning into something more flexible, like consulting or part-time work. Or, if you're starting a business, your income might be more variable, especially in the early stages. This means that adjusting your financial strategy to accommodate these changes is crucial. Income adjustments. Balancing new income with old obligations. For many who embark on a second career or start a business, there is often a need to adjust income expectations. If you're entering a new career that pays less than your previous one, or if your new business takes time to become profitable, it's essential to understand how this affects your financial plan. While income may initially be lower, it's important to balance this against the obligations you may already have. You may still be paying off a mortgage, funding your retirement, or supporting your family. A sudden drop in income could impact your ability to meet these obligations unless you have a plan to manage it. That's why reassessing your expenses and adjusting your lifestyle accordingly is a critical first step. Living on a tightened budget. In the early stages of a second career or business, you may need to adjust your lifestyle. Living frugally for a time could mean fewer luxuries, but may allow you to focus on building your new career without the constant worry of financial strain. Reassessing your spending and cutting back on non-essential expenses can free up cash to allocate toward your new venture. In addition to adjusting personal expenses, you might also consider alternative income sources. These might include part-time consulting or freelance work related to your previous career, which can offer more flexibility while supplementing your new income. Maximizing retirement contributions while earning less. One of the most significant financial concerns when transitioning to a second career is ensuring that your retirement savings continue to grow, even if your income is reduced. While starting a second career or business is often about creating immediate income streams, it's also essential to keep an eye on the future and preserve your ability to retire comfortably. Catch-up contributions. The IRS offers catch-up contributions to individuals over the age of 50 who are looking to make additional contributions to retirement accounts, such as a 401k or an IRA. This is an essential strategy for late career professionals. If you have a reduced income or your savings have been impacted by business costs, this tax benefit allows you to accelerate your retirement contributions in order to stay on track with your retirement goals. You might also consider tax-deferred savings options like an IRA or SEP IRA, simplified employee pension. If you're starting your own business or working as an independent contractor, a SEP IRA allows you to contribute significantly more than a traditional IRA, helping you catch up on savings more quickly. In addition to these options, setting up a Roth IRA can provide tax-free growth for the future, which can be especially beneficial in retirement. Understanding the costs of starting a business. Starting a business later in life can be rewarding, but it also involves significant upfront costs. You'll need to have a realistic understanding of the initial investment required and the time it may take before your business becomes profitable. Startup capital. Where will it come from? For many late-life entrepreneurs, a key concern is how to fund the startup costs of their business. You might consider using personal savings, taking a loan, or tapping into other resources, such as investments. In some cases, it might be possible to take a home equity loan if you own your home, but borrowing against your home or retirement savings can be risky if the business doesn't succeed quickly enough. Before diving into a new business venture, it's crucial to prepare for a cash flow gap. Cash flow issues are common in the early years of a business when revenue is not yet steady. This is particularly relevant when transitioning to a second career, as you may not have the same financial cushion you had in your first career. Creating a detailed financial plan with projected revenues, expenses, and possible cash flow shortfalls can help you plan accordingly. Insurance and liability protection. Business owners must also understand the potential liabilities that come with entrepreneurship. One of the first steps is ensuring you have the right business insurance. This might include general liability insurance, property insurance, workers' compensation, or even professional liability insurance if your new venture involves consulting or offering professional services. Additionally, structuring your business as a limited liability company, LLC or corporation, provides legal protection for your personal assets in the event of a lawsuit. By setting up the right legal structure for your business, you ensure that your personal wealth is shielded from business-related liabilities. Tax implications of starting a new career or business. Starting a second career or a new business comes with distinct tax advantages and responsibilities. Understanding these tax implications is critical to making informed decisions about your new career or entrepreneurial venture. Self-employment taxes. If you are moving into a freelance or entrepreneurial role, you will need to pay self-employment taxes. These taxes cover Social Security and Medicare, and they are typically higher than regular payroll taxes. As a self-employed individual, you are responsible for paying both the employer and employee portions, totaling approximately 15.3% on your net income. However, the good news is that there are tax deductions available for business expenses, such as office supplies, equipment, and even home office expenses. By properly documenting these expenses and taking advantage of these deductions, you can reduce your taxable income and mitigate the burden of self-employment taxes. Deductions for business owners. In addition to self-employment tax considerations, you'll want to take full advantage of the business deductions available to you. These deductions can significantly lower your taxable income, especially in the first few years of operation. Some of the key business deductions include startup costs. Costs associated with launching your business, such as market research, advertising, and legal fees, can be deducted. Operating expenses. These include rent, utilities, insurance, salaries, and office supplies. Depreciation. If you purchase significant assets for your business, such as equipment or vehicles, you may be able to depreciate the cost of these items over several years. Building a sustainable income from your second career or business. Whether you're starting a business or entering a second career, it's crucial to focus on long-term sustainability. The goal isn't just to generate income for today, but to ensure that your new venture can continue to support you in the future. This involves continually monitoring cash flow, adjusting your business model, and considering how to scale your income over time. For second careers, it may involve finding ways to increase your skill set, expand your professional network, and gain additional certifications or education that can enhance your earning potential. For business owners, scaling the business and diversifying your income streams will be key to success. As you grow, consider hiring employees, offering new products or services, or expanding into new markets to create multiple revenue streams that provide stability over time. Conclusion: setting yourself up for financial success. Starting a second career or business later in life is an exciting journey, but it requires a solid financial foundation. By reassessing your priorities, managing income fluctuations, leveraging tax advantages, and protecting your assets, you can set yourself up for long-term financial success. While challenges will arise, with careful planning and strategic decision-making, you can build a fulfilling, financially secure future that aligns with your goals. In the next chapter, we will explore practical strategies for managing risk and ensuring that your second career or business provides not just immediate income, but long-term wealth and financial independence. Chapter 2. Building a financial strategy for transitioning to a new career. Transitioning into a second career or becoming a late-life entrepreneur is both an exciting and financially complex journey. Whether you're starting a business or switching to a new profession, it is important to understand how this transition will affect your finances. Unlike a traditional career path, a second career or new business venture might come with more uncertainties regarding income, stability, and future growth. Therefore, building a thoughtful, comprehensive financial strategy is essential for ensuring that your financial future remains secure while you pursue your new goals. In this chapter, we'll walk you through the steps to build a strong financial plan that allows for a successful career transition or business startup. From assessing your financial situation to setting clear goals and adjusting your investment strategy, we'll cover the key elements that will help you move forward confidently. 1. Assessing your current financial situation. Before making any major financial decisions, it's crucial to take a step back and thoroughly assess where you stand financially. This is your starting point. Understanding your current financial health will guide your decisions about income, expenses, and how much you can invest in your new venture. Income and expense analysis. Start by reviewing your income from all sources, whether from a current job, investment income, or other side jobs, and compare it to your ongoing living expenses. Take note of fixed expenses like rent, mortgage, utilities, and insurance, as well as variable expenses like entertainment, travel, and dining out. Next, assess how much money you need for your new career or business. Will you need additional funds for startup costs? Can you reduce some of your personal expenses temporarily to account for potential income fluctuations during the early stages of your second career or business venture? These are crucial considerations. Creating a budget that reflects your financial reality during this transition will help you understand where adjustments can be made. You may need to tighten your spending temporarily to focus on your new career or save up for initial investments if you're starting a business. Building an emergency fund. It's also critical to have an emergency fund, especially if you're leaving a stable job to start your own business or enter a new industry. Financial experts often recommend saving at least 3 to 6 months' worth of living expenses. This fund acts as a cushion to cover unexpected expenses or income gaps during your transition. Having this safety net will allow you to focus on growing your new career or business without the constant worry of financial strain. 2. Setting clear financial goals for your new career. Once you have a clear understanding of your financial situation, the next step is to set specific and actionable financial goals. Your goals should reflect your aspirations and needs in this next phase of life. Whether you're starting a business, transitioning into a new career, or pursuing a passion project, defining your financial objectives will give you a roadmap for making decisions. Short-term financial goals. In the short term, your financial goals might focus on stabilizing your income and covering your basic living expenses. Starting a new business, for example, often comes with initial financial instability, and you may need time to build up a steady stream of income. Establish a target for what you need to earn within the first few months and create a cash flow projection to ensure that your income matches your expenses during the transition. This will help you set a clear expectation for when you might achieve financial stability. If you're pursuing a second career, you might aim for a specific salary or a certain number of hours per week. If you're starting a business, consider milestones like securing your first few clients or achieving a certain monthly revenue target. Setting these clear short-term goals will provide the structure needed to guide your progress. Long-term financial goals. For the long term, think about how your second career or business venture can support your long-term wealth and retirement goals. Your new career or business might offer more flexibility or higher earning potential, but the long-term success will depend on how well you can integrate this new income stream with your existing retirement and investment plans. For example, even though you may be focusing on short-term income needs, it's essential to continue contributing to your retirement accounts like an IRA, 401(k), or SEP IRA. If you are self-employed or working part-time, ensure you are using the appropriate tax-advantaged accounts to save for retirement. Many late-life entrepreneurs and second-career professionals don't prioritize retirement savings, but continuing to invest for the future is just as important as meeting current financial goals. 3. Adjusting your savings and investment strategy. Now that you've assessed your current financial situation and set your financial goals, it's time to turn your attention to your savings and investment strategies. In your first career, you may have been primarily focused on accumulating wealth for retirement or purchasing a home. However, with a second career or business, you need to rethink your strategy to ensure that your savings and investments support your changing needs. Rebalancing your portfolio. As you enter a second career or business, it may be necessary to reassess your investment portfolio to reflect your new financial reality. With fewer years to build wealth before retirement, you might need to adjust your risk tolerance. If you are close to retirement age or planning to rely on your business income in the future, a more conservative investment strategy might be appropriate. For those who are starting a business, there may be a need to take on more short-term risk in order to generate more income and growth in the early stages. Rebalancing your portfolio ensures that you maintain an appropriate risk level that fits your current financial situation and your long-term retirement goals. Maximizing tax-advantaged accounts. If you're transitioning into entrepreneurship, one of the best strategies for building wealth while minimizing taxes is to use tax-deferred retirement accounts, such as a SEP IRA or Solo 401k. If you're self-employed, these accounts allow you to contribute more than traditional IRAs, which is important when you're playing catch-up with retirement savings. These accounts also provide significant tax advantages. For instance, contributions to tax-deferred accounts lower your taxable income for the year, allowing you to pay less in taxes while still growing your retirement savings. Understanding how these accounts work is essential to minimizing your tax burden and optimizing your savings. 4. Managing debt during a career transition. When transitioning into a second career or business, managing existing debt is a crucial aspect of your financial strategy. Carrying high-interest debt or large amounts of credit card debt can add unnecessary financial stress during this transition period. A clear plan for managing or paying off debt will free up more of your income for savings and investment in your new career. Paying off high-interest debt. One of the first steps is to focus on paying off high-interest debts, such as credit card balances. If you're taking on debt to finance a business, carefully consider how much debt you can realistically manage. Avoid excessive borrowing, especially if the business is in its early stages and income is unpredictable. If possible, try to pay down any non-essential debts before you make the transition. By reducing your debt load, you will have more flexibility to invest in your new career or business without the burden of high monthly payments. Consolidating debt. If you have multiple debts with high interest rates, consider consolidating them into a single loan with a lower interest rate. Debt consolidation can simplify your finances and lower your overall interest payments. However, before consolidating debt, it's important to understand the terms of the loan and whether the consolidation will save you money in the long run. 5. Planning for healthcare and insurance needs. A crucial element of transitioning into a second career or business is understanding your healthcare needs. If you are leaving a job that provided employer-sponsored healthcare, you may need to find a new insurance plan. Additionally, for entrepreneurs, business insurance is a must-have to protect your assets. Health insurance options. If you are starting a business or working part-time, look into individual health insurance plans. The Affordable Care Act (ACA) provides a marketplace for health insurance where you can find plans that meet your needs. Depending on your income, you may qualify for subsidies to reduce premium costs. Business insurance. If you start a business, Consider liability insurance to protect your personal wealth from any claims related to your business activities. Whether it's general liability insurance, professional liability insurance, or property insurance, the right coverage will safeguard your personal assets from business-related risks. Conclusion: creating a sustainable financial plan. Transitioning to a second career or starting a business is an exciting yet complex process, especially when it comes to managing your finances. By carefully assessing your current financial situation, setting clear financial goals, adjusting your savings and investment strategy, managing debt, and securing the right insurance coverage, you can create a robust financial plan that supports your new career or business venture. While the transition may not be without its challenges, with a strategic financial approach, you can navigate this new phase of life with confidence, knowing that your financial future is secure and your goals are within reach. In the next chapter, we'll explore how to mitigate the risks associated with starting a second career or business and ensure long-term success and financial stability. Chapter 3: Managing Risk in a New Career or Business. Entering a new career or starting a business later in life is an exciting yet challenging step. While the potential rewards such as financial independence, personal fulfillment, and career satisfaction are significant, the risks involved must not be underestimated. Whether it's the uncertainty of fluctuating income, the risks associated with self-employment, or the possibility of business failure, understanding and managing these risks is crucial to ensuring the long-term success of your new venture. This chapter focuses on how to effectively manage the risks associated with a career transition or new business, and how you can reduce exposure to potential setbacks while positioning yourself for growth. We'll cover practical steps you can take, such as building a solid financial foundation, securing the right insurance, managing cash flow, and mitigating risks through diversification and planning. 1. Understanding the risks in a second career or business. Before we can manage risk, we need to understand the different types of risk that are typically involved when transitioning to a new career or starting a business. These risks can be broadly categorized into several key areas. Income instability. When you leave a stable job to start a business or transition into a second career, income becomes much less predictable. Unlike a salaried position where you receive regular payments, entrepreneurial income or part-time earnings often fluctuate. In the initial stages, you may not have a consistent flow of income, which can make it difficult to cover expenses and plan for future savings. Business risk. For those starting a business, there's always the possibility of business failure. According to various studies, many new businesses do not survive beyond the first few years. Whether due to poor cash flow management, insufficient market demand, or competition, it's critical to acknowledge that starting a business comes with a certain level of uncertainty. The financial and emotional investment required can be substantial, and not all ventures will yield the desired returns. Legal and liability risk. Running a business or even transitioning into a new professional role exposes you to potential legal risks. This might include issues such as contract disputes, employment-related lawsuits, or claims of negligence, especially for those in service-oriented industries. If you're not properly protected, you could be personally liable for any legal costs or damages. This is why understanding your liability and having the appropriate protection is so important. Health risks. A career transition or entrepreneurship can be stressful, which may affect your mental and physical health. The pressure of managing a business or navigating the complexities of a new role can lead to burnout, anxiety, or other health issues. In addition to these health concerns, you may lose access to employer-sponsored health insurance, making it crucial to secure the right health coverage. 2. Building a safety net, emergency funds and cash flow management. When stepping into a new career or business, the first line of defense against income instability is an emergency fund. Having financial reserves is critical for weathering periods of fluctuating income or unexpected expenses, especially in the early days of your transition. Creating an emergency fund. An emergency fund acts as a safety net that can help cover basic living expenses if you experience income gaps. A good rule of thumb is to save 3 to 6 months' worth of living expenses. This amount should be kept in a liquid and easily accessible account, such as a savings or money market account, to ensure that you can access it quickly if necessary. If you're starting a business, having an emergency fund becomes even more important. The first few years of business are often the most difficult, as cash flow may be inconsistent. Therefore, having sufficient reserves will allow you to focus on growing your business without the added pressure of financial strain. Cash flow management for entrepreneurs. If you are starting a business, managing your cash flow is one of the most important tasks for long-term survival. Many businesses fail because they run out of cash, not necessarily because they're not profitable. Cash flow management involves tracking the inflow and outflow of cash in your business to ensure that you can cover operational costs, pay employees, and reinvest in your business. You can manage cash flow by creating a detailed financial forecast that projects revenue and expenses for the first year or two. This will give you a clear picture of how much cash you need to keep your business running and when you expect to become profitable. Consider setting up a business credit line to provide a cushion if cash flow becomes tight. This can help smooth out any temporary cash shortages without having to dip into personal savings. 3. Protecting yourself with insurance. Insurance is a key component of risk management. Whether you're transitioning to a new career or starting a business, ensuring that you have the right coverage can protect you from potentially catastrophic financial setbacks. Insurance serves as a safeguard against various risks, including business liability, personal injury, and health-related issues. Health insurance. If you are leaving a full-time job that provided health benefits, you'll need to explore new options for health insurance. The Affordable Care Act, ACA, provides individual health insurance plans through state or federal marketplaces, where you may qualify for subsidies based on your income. As a self-employed individual, you may also want to consider health savings accounts, HSAs, which allow you to save for medical expenses on a tax-advantaged basis. This type of account can help reduce your overall healthcare costs while you are building your business or transitioning to a new career. Liability insurance for entrepreneurs. If you are starting a business, liability insurance is one of the first policies you should consider. It protects your business and personal assets from claims made by third parties. There are several types of liability insurance. General liability insurance covers incidents such as accidents, property damage, or bodily injury that may occur on your premises or as a result of your products or services. Professional liability insurance is especially important for those offering professional services, such as consultants, accountants, or lawyers, as it protects against claims of negligence or failure to perform professional duties. Product liability insurance is relevant if you manufacture or sell products, covering claims related to product defects or injuries caused by your products. Having the appropriate liability insurance ensures that your business is protected against unforeseen legal expenses that could otherwise drain your finances. Disability and life insurance. As you transition into a second career or new business, disability insurance becomes critical, especially if your income depends on your ability to work. Disability insurance provides income replacement if you are unable to work due to illness or injury. For entrepreneurs, this is especially important, as the success of the business may depend heavily on your ability to continue working. Additionally, life insurance is a key tool for protecting your loved ones and business partners in the event of your death. It can provide financial security to family members and ensure that your business remains financially stable even in your absence. 4. Diversification. reducing risk across assets. Whether you are managing personal wealth or business assets, diversification is a fundamental strategy for reducing risk. By spreading your investments across different types of assets, stocks, bonds, real estate, or business interests, you can minimize the risk that any single investment will adversely affect your financial health. Personal investment diversification. For individuals transitioning into a second career or starting a business, diversification can help ensure that your wealth is not entirely tied to one source of income. For instance, even if you're focused on your business or second career, you should maintain investments in stocks, bonds, or retirement accounts to create multiple revenue streams. By doing so, you reduce the impact of any downturn in your business or career, allowing you to rely on other assets for financial security. Business diversification. For business owners, diversifying your income streams is equally important. Relying on one product, service, or client base exposes your business to unnecessary risk. If demand for your product or service declines, or if a major client leaves, it can dramatically affect your cash flow. Expanding your offerings, entering new markets, or diversifying your customer base can help shield your business from these risks. 5. Risk of personal liability, protecting yourself. For those transitioning into entrepreneurship or taking on a second career, one of the most significant risks is personal liability. If you run a business or provide services, legal claims and financial losses could put your personal assets at risk. Structuring your business appropriately is a powerful way to protect your wealth. Incorporating your business. When you form an LLC, S corporation, or other corporate entity, you create a legal separation between your personal assets and business assets. This shields your personal wealth from business-related liabilities, ensuring that only business assets are at risk in the event of lawsuits or financial troubles. Incorporating your business is one of the most effective ways to protect your personal assets and reduce your financial exposure. Conclusion. Managing risk for a secure future. The risks associated with starting a second career or a new business are real, but with careful planning, they can be managed and mitigated. By taking proactive steps such as building an emergency fund, securing insurance coverage, diversifying income sources, and protecting your assets with the right legal structures, you can significantly reduce the financial impact of these risks. Transitioning into a new career or launching a business later in life requires you to take control of your financial future. Through thoughtful risk management, you not only protect your wealth but also create a foundation that allows your career or business to thrive. With the right strategies in place, you can move forward with confidence, knowing that you've taken the necessary steps to secure your financial future and achieve your goals. Chapter 4. Tax planning for second careers and late-life entrepreneurs. When transitioning into a second career or launching a business later in life, one of the most important and often overlooked aspects of your financial plan is tax planning. Taxes can significantly affect your income, savings, and long-term wealth accumulation. As a second career professional or entrepreneur, you need to understand how to structure your finances, manage your income, and take advantage of available tax breaks to minimize your liabilities and maximize your financial gains. In this chapter, we will explore the essential tax considerations for second career professionals and late-life entrepreneurs. From income tax strategies to retirement account contributions and deductions, we'll cover everything you need to know to keep more of your hard-earned money. 1. Understanding tax obligations for second careers and entrepreneurs. When you transition to a second career or business, the nature of your income changes. If you're starting a business, you will become self-employed, which brings with it additional tax responsibilities. It's crucial to understand how income is taxed in these situations to avoid surprises when tax season arrives. Self-employment tax. One of the key tax considerations for entrepreneurs and independent contractors is the self-employment tax. Unlike traditional employees who have taxes withheld by their employers, self-employed individuals are responsible for paying both the employer and employee portions of Social Security and Medicare taxes. This amounts to a total of 15.3% on your net earnings, which is higher than the 7.65% you'd pay as a traditional employee. While this may sound like a disadvantage, there is a silver lining. Self-employed individuals can deduct the employer portion of the self-employment tax when filing their taxes. This deduction effectively reduces your taxable income, but you are still responsible for paying the full 15.3% on your net earnings. Income tax brackets and deductions. Whether you're self-employed or transitioning to a part-time job, the tax bracket you fall into will depend on your income. The U.S. uses a progressive tax system, which means the more you earn, the higher the percentage of your income you'll pay in taxes. Understanding which tax bracket you fall into helps you estimate your tax liability and plan accordingly. Additionally, being self-employed opens the door to various tax deductions that are not available to traditional employees. These include business expenses. Anything necessary for running your business, whether it's office supplies, equipment, software, or business travel, can generally be deducted. Home office deduction. If you run your business from home, you may be eligible to deduct a portion of your rent or mortgage, utilities, and internet expenses. Health insurance premiums. As a self-employed individual, you may deduct the cost of health insurance premiums for yourself and your family. Taking advantage of these deductions can significantly lower your taxable income, thereby reducing your overall tax burden. 2. Managing retirement contributions as a late-life entrepreneur. Retirement planning is especially important for second-career professionals and entrepreneurs who may not have as much time to accumulate retirement savings as younger workers. Fortunately, there are several tax-advantaged retirement accounts that allow you to build wealth while reducing your taxable income. Let's explore the different retirement planning options that can help you save for the future. Traditional IRA and Roth IRA. Whether you're employed full-time, working part-time, or running your own business, a traditional IRA or Roth IRA can provide tax benefits. Both types of individual retirement accounts allow you to save for retirement, but they differ in how they are taxed. Traditional IRA. Contributions to a traditional IRA are tax-deductible in the year they are made, meaning you pay no taxes on that income until you withdraw it during retirement. This can be especially beneficial for late-life entrepreneurs who may want to reduce their taxable income in the year of their business startup or transition. Roth IRA. Contributions to a Roth IRA are made with after-tax dollars, but the benefit is that any earnings in the account grow tax-free, and withdrawals in retirement are also tax-free. Roth IRAs are an excellent option for those who expect to be in a higher tax bracket during retirement or want to avoid taxes altogether in retirement. The maximum contribution limit for IRAs in 2023 is $6,500 for individuals under 50 and $7,500 for those aged 50 and older, known as the catch-up contribution. Solo 401k and SEP IRA for self-employed individuals. For entrepreneurs or self-employed individuals, Solo 401k and SEP IRA accounts provide larger contribution limits than traditional IRAs. These accounts are especially beneficial if you have a significant income from your business and are looking to maximize retirement savings. Solo 401k. A Solo 401k allows you to contribute both as an employer and an employee, allowing for much higher contribution limits than a standard IRA. As an employee, you can contribute up to $22,500 or $30,000 if you're 50 or older in salary deferrals. As an employer, you can also contribute up to 25% of your compensation, bringing your total contribution potential to up to $66,000 in 2023 or $73,500 if you're over 50. SEP IRA, the Simplified Employee Pension Plan, SEP IRA, allows business owners to contribute up to 25% of their income, with a cap of $66,000 in 2023. A SEP IRA is simple to set up and maintain, making it ideal for solo entrepreneurs or small business owners who want a straightforward way to save for retirement. These accounts offer substantial tax advantages by allowing your contributions to grow tax-deferred until retirement. For late-life entrepreneurs, they provide a critical opportunity to catch up on retirement savings. 3. Tax-advantaged business deductions for entrepreneurs. As a business owner, you can take advantage of several business deductions that help reduce your taxable income. Deductions are important for offsetting the costs of running your business and lowering your overall tax burden. Here are some of the most common business-related deductions for entrepreneurs. Startup costs. When you start a new business, you can deduct various startup costs, such as market research, advertising, legal fees, and other initial expenses. You may also be able to deduct costs related to training, travel, and the purchase of equipment necessary to run your business. However, it's important to keep in mind that startup costs are subject to certain limits and regulations, so it's a good idea to consult with a tax professional to ensure you're properly accounting for these expenses. Home office deduction. Many entrepreneurs and late-life business owners operate from home, and the home office deduction allows you to write off a portion of your home-related expenses, such as rent or mortgage interest, utilities, and insurance. To qualify for this deduction, your home office must be used exclusively and regularly for business purposes. The IRS allows you to use two methods for calculating your home office deduction. The simplified option, where you deduct $5 per square foot of home office space, up to 300 square feet. The regular method, where you deduct the actual expenses based on the percentage of your home used for business. 4. Minimizing taxes with strategic business planning. In addition to maximizing tax-advantaged accounts and deductions, there are other strategies that late-life entrepreneurs can use to minimize taxes and grow their wealth. Timing your income and expenses. One of the most effective tax planning strategies for entrepreneurs is timing your income and expenses. By managing when you receive income and when you pay expenses, you can strategically control your taxable income. For instance, if you know you'll be in a lower tax bracket in the current year, you might want to accelerate income into that year to pay lower taxes. On the other hand, you might want to delay income until the next tax year if you expect to be in a higher bracket. Likewise, you can strategically time your business expenses. For example, if you have large business purchases or investments, it may make sense to make those purchases in the current year to reduce taxable income. Business entity selection, LLC versus S Corp. Another critical decision for entrepreneurs is how to structure their business. Choosing the right business entity, LLC, S Corp, etc., has significant tax implications. For instance, setting up an S corporation, S Corp, can help reduce self-employment taxes, as you can pay yourself a reasonable salary and treat the rest of your business income as distributions, which aren't subject to self-employment taxes. However, forming an LLC provides limited liability and flexibility in taxation, as it can be taxed as a sole proprietorship, partnership, or corporation. Depending on your income level and business structure, consulting with a tax advisor can help you decide on the best business structure to minimize taxes and maximize your financial benefits. 5. Hiring professionals to maximize tax efficiency. While it's possible to handle your taxes on your own, the complexity of tax planning for second careers and late-life entrepreneurship can often require professional advice. A tax professional, such as an accountant or CPA, can help you navigate the intricate landscape of business deductions, retirement contributions, and self-employment taxes. They can also help you stay compliant with tax laws while maximizing tax-saving opportunities. Consulting with an estate planner or financial advisor is also essential for long-term wealth management. These professionals can help ensure that your wealth protection and retirement planning strategies are aligned with your financial goals and tax needs. Conclusion: strategic tax planning for long-term success. As you embark on your second career or entrepreneurial journey, effective tax planning is essential to securing your financial future. By understanding your tax obligations, leveraging tax-advantaged retirement accounts, and taking advantage of business deductions, you can minimize your tax liabilities and maximize the potential for growth in your business or career. Transitioning to a second career or becoming an entrepreneur may bring unique challenges, but with strategic tax planning, you can make the most of these opportunities and ensure long-term financial security. In the next chapter, we'll explore risk management strategies for late-life entrepreneurs and professionals, helping you safeguard your wealth and position your business or career for long-term success. Chapter 5. Retirement Planning for Late-Life Entrepreneurs. Transitioning into entrepreneurship later in life is an exciting journey, but it also brings with it a host of financial considerations, especially when it comes to retirement planning. For late-life entrepreneurs, the question of how to balance the growth of your business with your long-term retirement goals can feel daunting. You may have fewer years to grow your wealth, and your income may not be as predictable as it was in your previous career. However, with thoughtful planning, starting a business later in life can still be an effective way to build wealth and secure your future. In this chapter, we'll explore the key strategies for managing retirement planning as a late-life entrepreneur, including how to continue building your retirement savings, manage business income, and maximize tax advantages. 1. Balancing business growth with retirement savings. As a late-life entrepreneur, one of your main challenges will be balancing the immediate needs of growing your business with the long-term goal of saving for retirement. The early years of entrepreneurship can be unpredictable, and it's easy to become consumed with reinvesting profits into your business. However, it's crucial not to neglect your personal retirement goals while focusing on your business. Setting up a retirement plan for your business. One of the first steps in retirement planning as an entrepreneur is to set up a retirement plan for your business. As a business owner, you have the opportunity to save for retirement using tax-advantaged accounts, but the type of account you choose will depend on your business structure. If you are a sole proprietor, you may want to consider opening a SEP IRA, Simplified Employee Pension, which allows for high contribution limits up to 25% of your income, or $66,000 for 2023, whichever is less. This plan is simple to administer and can help you accelerate your retirement savings while reducing your taxable income. Alternatively, if your business is structured as an S corporation or C corporation, you can set up a solo 401k. The solo 401k allows you to contribute up to $22,500 annually, or $30,000 if you're 50 or older, plus an additional employer contribution of up to 25% of your income, which can add up to $66,000 or more in total contributions. For businesses with employees, profit-sharing plans and defined benefit plans can provide additional options for retirement savings. Consulting with a financial advisor or retirement plan specialist can help you select the best plan for your needs. 2. Building your personal retirement fund. As an entrepreneur, your retirement may rely heavily on the business you are building. While the growth and eventual sale or transition of your business could be a significant part of your retirement plan, it's important to also build a personal retirement fund to ensure that you are financially secure if your business doesn't generate the returns you expect, or if you decide to step away from the business in the future. Contributing to traditional or Roth IRAs. Even if you have a business retirement plan in place, contributing to an individual retirement account, IRA is another great option for late-life entrepreneurs. Traditional IRAs allow you to contribute up to $6,500 per year, or $7,500 if you're over 50, in pre-tax dollars, which reduces your taxable income. On the other hand, Roth IRAs allow you to contribute after-tax money, and the benefit is that the money grows tax-free, and withdrawals in retirement are also tax-free. Roth IRAs are particularly useful if you expect to be in a higher tax bracket in the future, as you pay the tax on the contributions now, while enjoying tax-free growth and withdrawals later. The flexibility of IRAs gives entrepreneurs the ability to diversify their retirement savings, regardless of the type or size of their business, maximizing contributions as you approach retirement. As you approach retirement age, you can take advantage of catch-up contributions. Individuals over the age of 50 are eligible to contribute more to their retirement accounts. For example, the catch-up contribution for IRAs is an additional $1,000 per year, bringing the total contribution limit to $7,500 for those 50 and older. For 401 plans, the catch-up contribution is $7,500, allowing you to contribute up to $30,000 annually. 3. Considering the business exit strategy. For many late-life entrepreneurs, the exit strategy becomes a key component of retirement planning. Your business may become the primary asset that funds your retirement. Therefore, it's essential to plan for how you will eventually exit the business. This strategy involves preparing your business for sale, identifying potential buyers, or transitioning the business to a family member or key employee. Selling the business. If selling your business is part of your retirement plan, there are several financial and tax considerations to keep in mind. First, the sale of a business may trigger capital gains taxes, which could significantly reduce the amount you actually receive from the sale. There are strategies, such as utilizing 1031 exchanges or structuring the sale as an installment sale, that can help reduce the immediate tax impact. Planning ahead can ensure that the sale generates enough proceeds to fund your retirement. Business succession planning. If you want to pass your business on to a family member or employee, it's important to establish a business succession plan. This plan outlines who will take over the business, how the transfer will happen, and what financial and legal steps are involved. A well-thought-out succession plan can ensure the continuity of the business while also allowing you to retire comfortably. 4. Managing healthcare and insurance needs. Healthcare becomes increasingly important as you near retirement age, and transitioning to entrepreneurship can complicate your access to health insurance. When you leave a traditional job, you may lose employer-sponsored health benefits, so securing your own coverage is crucial. Health insurance options for entrepreneurs. As an entrepreneur, you'll need to secure your own health insurance through the Affordable Care Act ACA marketplace or private insurers. Depending on your income level, you may qualify for subsidies through the ACA, which can significantly lower your premiums. However, it's important to assess your needs and shop around for the best plan that fits your health and financial situation. Additionally, as a self-employed individual, you may be eligible to deduct the cost of health insurance premiums for yourself and your family on your tax return, which can reduce your taxable income. Disability and long-term care insurance. For late-life entrepreneurs, disability insurance is critical. If you are injured or become ill and unable to work, disability insurance can provide a portion of your income until you recover or retire. As a business owner, you may also need long-term care insurance to help cover the cost of medical care as you age, particularly if your health declines and you need extended care. Having both types of insurance in place will provide financial security in case of unexpected health events and allow you to focus on your business without worrying about how you will cover medical expenses. 5. Transitioning to retirement, planning for the final years. As a late-life entrepreneur, the key to a successful retirement is ensuring that your business or career supports your long-term financial needs. Retirement planning for entrepreneurs isn't just about saving for the future, but also about creating a plan to transition out of work and into retirement, creating a sustainable income stream. Once your business is running smoothly, it's essential to create a reliable income stream for retirement. This may include selling the business, generating income from investments, or drawing down retirement accounts. By ensuring that your business is financially self-sustaining, you can ease into retirement with confidence, knowing that your assets will continue to provide income, Social Security and other retirement income. If you're eligible for Social Security benefits, understand how those benefits will factor into your retirement plan. Social Security can supplement your income, but it's unlikely to be sufficient on its own, especially for entrepreneurs who may not have been paying into the system as consistently as traditional employees. Conclusion: building a secure retirement as a late-life entrepreneur. Starting a business or transitioning to a second career later in life may present unique challenges, but with a thoughtful and comprehensive approach to retirement planning, you can secure your financial future. Balancing the growth of your business with the need for retirement savings, creating a clear exit strategy, securing adequate insurance coverage, and managing healthcare costs are all essential pieces of the puzzle. By focusing on these key areas, you can ensure that your entrepreneurial journey not only provides financial success today, but also sets you up for a comfortable, worry-free retirement. Remember, your late-life business can be a path to financial independence, but careful planning is necessary to ensure that it serves your future needs and protects the wealth you've worked so hard to build. Embarking on a second career or starting a business later in life is more than just a financial decision. It's a commitment to personal growth, fulfillment, and the pursuit of passions that may have been set aside during earlier years. It's an opportunity to reshape your life, redefine your professional identity, and, importantly, secure your financial future. However, achieving true success in this new phase of life requires more than just hard work and ambition. It demands careful financial planning and strategic decision-making. As we've explored in this audiobook, building a strong financial foundation is key to navigating the unique challenges of a second career or entrepreneurial journey. From assessing your current financial situation to understanding tax planning, creating an emergency fund, and diversifying your income sources, each step is crucial in ensuring that your goals are met while protecting your wealth. By adopting a proactive approach to your finances, whether it's managing income fluctuations, safeguarding assets, or strategically planning for retirement, you empower yourself to make confident decisions, knowing you are setting up a sustainable future. The financial strategies outlined here are not just about securing your wealth. They are about creating a life where you can thrive, both professionally and personally. Transitioning into a second career or starting a new business can be transformative, allowing you to embrace new challenges, explore fresh opportunities, and build the financial stability that supports your long-term goals. With the right mindset, resources, and strategies in place, you can achieve financial security while pursuing the personal fulfillment that comes from doing work that excites and motivates you. As you move forward on this exciting journey, remember that it's not just about the destination. It's about creating a balanced, meaningful, and financially secure life every step of the way. You have the power to make this next chapter in your life your best one yet.